Hi everyone, Cam Roberts here. Welcome to the Business and Wealth broadcast. I'm joined today by my good friend, real estate authority, author, speaker, and multi-millionaire Trent Giumelli. Trent, thanks for coming on the show.
No worries, mate. Thank you for having me.
Now, before we kick off, we're just getting a bit of feedback from your speaker. Can you see if you can just fiddle that around and try and fix that up a little bit?
Is that a bit better or not?
Maybe. Let me just see if it might be mine. Hang on a sec. How's that? Is that any better for you?
Yeah, it's fine by me.
Okay, that's a bit better. Whatever you've done then, that's great. So we'll continue on. So welcome, everyone. It's really good to have Trent on today. Now, Trent, we're going to be talking about the rising interest rates in the housing market and the bumpy road ahead. Now, tell me, is this a storm or is it a major correction? What are we looking at?
Look, I've said for some time, when the market goes, it's going to go pretty hard. I think in our last podcast thing, we said I always called it 29 on steroids. When it turns the other way, it's going to be cataclysmic. And certainly, there's things that are happening at the minute that are certainly pushing it towards that right now. You look at China, you look at the States and everything in between. There's warnings coming out left, right, and centre. So I don't know when, but certainly it's looking like it will be on the path to, to being a fairly major storm and a major correction at some point in time. Surely. And
your microphone's just dropped out a little bit again. Can you see if you can fiddle that around and see if you can fix that up?
Sorry about that. Joys of technology.
Yeah, joys of technology, folks. Just while Trent's fixing that, if we don't get it live this time, we might redo it. And I'll just read some of the notes that we're going to be talking about just while Trent's trying to fix that up.
Is that any better or not?
Yeah, that's better now.
I'll just stand a bit closer. It seems to work a bit better.
Okay, cool. So, yeah, sorry, folks. Look, marvels of technology these days. But, Trent, one of the questions I wanted to ask was, what can we expect from an interest rate rise? If interest rates are on the rise, what does that mean for people?
Well, I mean, you've got to look at the fundamentals as to why interest rates will go up. And obviously, inflation is a major issue right now. We spoke about it last time. You just got to look at fuel prices for the sake of the exercise. I mean, they've almost, in Australia, they've gone up 50 cents. I mean, overseas, they've almost doubled. And, the property market is well and truly alight. There's no question about that. So is the share market. So what they will do is they will try and calm that down, and they'll do that via raising interest rates. So, all things looking, it could go up, somewhere between 0.5% to 1.5% starting next year.
What does that mean for a lot of people? Obviously that people borrow money for their houses, they borrow money for investments. Like, when we hear that thrown around a lot, interest rates are going up and, all that sort of stuff. But what does it really mean for people, either in housing or real estate or investing?
Yeah, look, very, very simply, I mean, if it goes up 1%, say, and the average loan in Sydney, for instance, sake, is $750,000. There's $7,500 a year just added to the bottom line. That's straight off your income.
Right.
And then you've got fuel prices going up, so that comes straight out of your income. And all these other things, food, everything else is going up in between. Private health is a great example of that one. All these costs just keep creeping up. So this inflationary, hidden inflationary figure just keeps hammering everyone, and obviously costs a lot more money on, your net pay.
And so we hear that, everything's going up. What do you see as the best opportunities or the best investments to get into now, if there is any to get into?
Yeah, there's multiple. It's not just property. I mean, you've got to look at opportunities that can either rise at the same amount of inflation. Obviously, having cash in a long-term deposit at the minute's not that, because you'll get 0.5% if you're lucky. But then you look at things like gold, like silver, possibly crypto, or real estate. It depends on what people are comfortable with, but there's multiple different options and sources that you can put your money somewhere else where you know that it's going to come up with inflation or be in front of inflation. And that's why we, heavily diversified about 12 months ago into different markets. I mean, crypto, gold, silver. I obviously invest in cars and things like that as well, because I wanted to get my money out of the bank and put it into solid assets that I know at any one point in time I could sell and keep up with that inflationary rise.
Yeah. And, we hear a lot of the experts or, gurus in this space, they talk about China. Like, does China have anything to do with global interest rates? Have they got, any hand in all of this? Or is this just something that's been forming over the years?
I think it's both. So obviously it's been forming for a long period of time, but more so just recently, if you don't know about the Evergrande Group out of China, I think they've got about $300 billion in debt. We mentioned this last time. There's going to be a huge ripple effect if that goes down. Now they've just missed two or three bond payments, which is not good. That's certainly, China obviously acquire a lot of resources from Australia. They deliver a lot of goods all over the world, so it will have a ripple effect to everyone if they go down. And that could be the catalyst that starts the whole drive on the interest rate rise. I don't know at this point, but certainly it is a major concern to be watching out for that specific thing alone, because they do hold a lot of property in China. I think they're the largest property owner or developer owner in China, but a lot of their properties are untenanted. They're just empty buildings. So that's going to see a huge market. I think their share price has gone down something like 70% in the last month. Yeah. So it will have a ripple effect. I don't know how much, but certainly, the writing's on the wall with what will happen. I think it's probably going to have a fairly big shunt to our stock market, particularly with resources. That's where I think we're probably going to get hit the hardest. But certainly, again, as I mentioned, right around the world, I mean, they produce a lot of stock. It's where everyone obviously made in China, so to speak. So that's all going to have a ripple effect to every country around the world as well.
And you spoke about some of the strategies that people can get into to keep ahead of the interest rate rise. Yep. What are some of the things that they should be avoiding right now, knowing that the interest rate rise is around the corner? It's going to be a bumpy road. Are there anything they should be avoiding?
Look, whilst I can't give advice around all this sort of stuff, for me, I'd be avoiding things like term deposits and things like that. There's a thing called I think in 2018, there was a thing called the bank bail-in law. We've spoken about this previously, where the banks, if the banks go down, they can hold your assets. Yes, there's a protection of funds in there, but it's only to a certain point. Gold and silver in particular has gone berserk. It's very, very hard to get at the minute. And even getting cash out of the bank's quite difficult. But you just don't want to be putting your money into silly investments or wasting your money on silly things. You want to be looking at fundamental investments that, as I said earlier, just go up with inflation or exceed inflation. I mean, some of our rentals that we're getting on our sites are above 20% because of the way we structure them. So you've just got to get your money working for you in the right areas and not be, frivolous with going and buying silly things. I mean, it could be a watch, it could be just, dumb retail things that you would buy with your money versus putting it into something that's safe and secure that you can advance moving forward.
Yeah, that's really good. And what are some of the, I don't know if you can share with us or not, but what are some of the results that some of your members have achieved over the last, 6 to 18 months using some of the strategies that you teach them, or even some of your own strategies that you've done for yourself?
Yeah, I mean, I've sold a couple of cars, for instance, sake, that have yielded, 1,500% yields. Gold and silver I bought very, very early, and it's just been a progressive uptake. I paid $1,000 an ounce, for instance, sake. It's currently 1,800. So you can do the math there. And then you've got things like, the real estate stuff. Most of our clients, it generally walk away with somewhere between 25 and 50% return on their money over the course of a project. We've now opened up where clients can actually participate in long-term hold of projects whereby, we do our light industrial commercial man caves, and then we do a mix of self-storage and renting those out similarly, and that's where we're able to achieve those high rental yields as well. So we've got clients that want to stay in that sort of stuff because there's a nice ownership base. Everyone loves property purely and simply because it's that touch and feel and smell thing. They can see it. And that's where a lot of people are dumping money in at the minute is the real estate market.
Yeah. And if someone, doesn't know how to do these strategies and that sort of thing, is that something that you help them with?
Absolutely. I mean, I had a friend of mine say to me the other day, he said, I was talking about building a car with him, and I said, I've done some work and blah, blah, blah. And he said, well, you're a property developer. He said, I don't know the first thing about your field. You don't know the first thing about mine. Why are you going to do it? So, yeah, of course we help people out. It's our passion. It's what we've done, our life's work, if you want to call it that. And we get great enjoyment out of working with, good people and they too with us because they're getting something in return for not a lot of work. I mean, obviously, it takes a little bit of work to do it all, but they're happy walking away with the percentage rates that I suggested a little bit earlier.
Yeah, excellent. And I know you have there's a web class that people can go and watch and go through. So what we'll do, we'll share the web class URL in the comments below. And what's the process once someone goes through the web class and they're interested? What's the next steps that they can expect to go through?
Very, very simple. Watch the web class. If it's of interest, you register your details. We have a one-on-one just to make sure we're the right fit for you and vice versa. We're very, very particular with stuff like that. If not, all good. It's not for everyone. We understand that. But if it is, you sign you fill out the form. We jump on a Zoom call, go through the bits and pieces with you, make sure both parties are happy. If you're happy, you then join the program. It's very simple. There's no hard sells in what we do. It's just nice and fluid and just feeling each other out and making sure, as I said, that we're the right fit for you, but also we're the right fit for you're the right fit for us as well.
Excellent. And just to finish up, what are some of the historical data returns that people can expect when they get involved?
Yeah, so our fund typically pays 5% per annum on the basis, and then we've been doing anything from, as I mentioned, 25% returns up to 50% and sometimes higher. I've got one finishing at the minute that will probably do 50 to 60%. So it just depends on the project. They're all different. They all operate differently. It's like having a child or multiple.
Yeah.
So they all do their own thing at times. But historically, with the warehouse stuff or the light industrial stuff that we do, we're finding that the average returns are somewhere between 40 and 44% at the moment.
Excellent. All right, very good. So, what I'll do, I'll grab that link and I'll put it in the comments below. And
sure.
Trent, thanks very much for coming on the show today.
Welcome, mate. Thank you. Thanks for having me as always. Hello to everyone.
Yeah, learning more about your wealth building and real estate strategies next week.
Absolutely.